Hey there, everybody. Hope you are doing fantastic. I wanted to reach out to you here with a state of the market report. Obviously, there are a lot of moving parts here in not just the real estate world, but also the overall economy. And it seems like everywhere we turn, we are seeing headlines that are out there that are making people question things, making people question, what are we to expect when it comes to the economy? Do we have a recession? Is the inflation out of control right now? What can we do to combat that? Not to mention, obviously, what we have internationally with a war going on in Ukraine. So lots of questions out there, lots of uncertainty. So what I hope to do was to give you a little bit more certainty as to the facts, as to ultimately what is going on in the real estate market, not just locally here, but nationally as well. And what are we going to see as we move forward throughout the rest of 2022? And then I'm going to finish up a little bit with some projections as what we might see over the course of the next 5 years or so. So that being said, a lot of this information I've gotten from third-party sources. I'm obviously not an economist, but I try to take the data and kind of translate it and see how it affects us here locally, and then what to expect, obviously, from a national level. So the question I've gotten a lot from our consumers, whether it be a buyer or a seller, is what's going on with interest rates? Mortgage interest rates have shot up very quickly here. And in fact, we're up about 1.5% here in 2022, just to start off the year. So what's going on with that? And then what do we expect to see? And I'll say this, that high inflation is the enemy of long-term interest rates. So what does that mean? Well, as we are seeing high inflation, the Fed has to use the tools they have to try to combat high inflation. And the number one way to do that is to increase interest rates. And that ultimately then in turn affects our long-term mortgage rates. So with it, we have seen a jump in interest rates relatively quickly. And as I mentioned, we're up about 1.5%. We started the year right around 3.1, 3.25, and now we are seeing rates that have bumped up to about 5%. Here for second homes in the second home condo market, we're actually seeing rates that are a little bit higher than that. So what does that mean? Well, one of the interesting things that happens when interest rates rise, and this goes back all the way to the 1990s, but every time where we have seen interest rates rise at least 1%, we have in turn seen home prices rise. In fact, dating all the way back, like I mentioned, to 1993, every time we've seen at least 1% increase in interest rates, mortgage interest rates, the average increase in home prices has been 8%. So that's a huge amount of increase when it comes to the home values and appreciation. In fact, here we've seen interest rates go up 1.5% here in 2022, but at the same time, we've seen prices already appreciate in 2022 about 15%. So interest rates go up, prices go up. Now, what does that do to actual home sales? And it's a very interesting dynamic. Typically, what happens is when those rates go up, people have a tendency to either get off the fence and decide, yes, I am going to go ahead and make a purchase, or they do the opposite. They typically pull back and say, you know what, right now rates have gotten higher than I'm comfortable with, and or their affordability factor has squeezed. So you have this yin and yang effect where some people are either going all in because they want to make sure that they go and they buy before rates possibly get even higher, and then others who just seem to pull back. But over the long term, going back to the 1990s as well, when interest rates shoot up, typically that will slow the actual number of sales to some extent. And we've seen that. Our number of sales are down a tad here in 2022 compared to years in the past. And some of that has to do with the very real affordability piece. Some people just cannot afford what they had wanted to at one point. So here's the opportunity in that. Demand is still extremely high, and I'm going to show you some numbers here locally in a few minutes. But the inventory is low, demand is still high, prices are going up, there's lots of competition, but I will say this, when there is a little bit less buyers in the marketplace, there is a little bit less competition. So if you were a buyer and you were looking 3, 6, 9 months ago, you could have been faced with this multiple offer situation where you would have seen anywhere from 6 to 10 possible offers on a property, and the competition was really stiff. Well, we're still seeing lots of competition, but in this case, it might be 2, 3 offers that you're competing with. So your chances of actually getting an offer accepted have actually increased and could increase as the year goes on. So just in recapping there, inflation, to combat inflation, the Fed has to raise interest rates. That in turn has raised the mortgage rates relatively quickly. That has made prices continue to rise, while at the same time the number of sales has dropped a little bit. From a projection standpoint, this coming from Freddie Mac, quote basically says that mortgage rates are likely to continue to move higher throughout the balance of 2022, although the pace of that rate is likely to moderate. So one thing that's happened with that, with the Fed coming out and actually just last week raising the federal funds rate 0.5%, many of the mortgage companies have already baked in their increase in mortgage rates. So we're sitting right now just over 5% on a 30-year fixed mortgage. That will probably continue to rise, and it's not completely certain as to how far it will go this year, but many of the experts are expecting that that's going to moderate and will probably shake out in the 6% range come the end of 2022. So those big jumps, hopefully they're behind us at this point. There might be a little bit less competition for you as some of the buyers have exited the marketplace. That could be a great opportunity for you as a buyer. Another thing I wanted to point out, since we have seen these interest rates rise so quickly, we've seen some interesting things take place in the stock market, and the tech sector and many of these growth companies do not like the fact that interest rates have risen so quickly. So we've seen some downturns and some volatility in the stock market. So what happens when we have volatility there and the possibility that that could decline a little bit is we see many people diversifying their assets. So they're running to something that's a little bit more stable, and we see this diversification. And this especially has been true at the higher end, where we've seen a mass influx of cash buyers. People who have taken their money, their earnings that they've gotten over the last couple of years in the stock market, and have decided to diversify and pull that cash out and put it into real estate. So in certain segments of the market, actually the competition has gotten even a little bit steeper, because you've got these buyers who have seen higher interest rates, so their affordability has squeezed, and then we have this influx of some cash investors who've come in. And as we know, it is somewhat difficult to compete with an all-cash buyer. But keep an eye out on that. The diversification piece is something that is very real and something you may want to consider as well. If you've had earnings in other spots, it might be time to take that cash out, put it into something that's tangible, that you can use, you can see, you can come to the beach and smell the salt air, as well as feel the breezes on your face. So it's actually a real asset, and that might be something you'd want to consider. Another question that I get hit with a lot, and we're starting to see this make the headlines, is, are we in a real estate housing bubble? And I think the first thing we all think of when we think of a bubble is we think back to 2007, 8, 9, into 2010, with the big bubble bursting really back in 2008. And what I want to say with that is I've done a lot of research on this. I go to a lot of economists, real estate economists, to get their take on what we may see. And the big thing is, this time is different. The fundamentals of a bubble and fundamentals of what we saw from our memory of 2008 are much different right now. And a lot of that has to do with lending standards. If you recall back in 2004, 5, 6, when we saw prices shoot up very quickly, we did not have a real supply and demand issue back then. In fact, here in Ocean City, on almost every corner, there was a new construction project. So there was lots of supply. Obviously, there were some bidding wars back then. There were some situations where the best properties had multiple offers in them. But all in all, we had much more inventory back then than we currently do today. So it wasn't a supply-demand issue, but rather it was a lending standards issue. And one thing I want to point out is when we look back at the default risk, the risk of consumers that have mortgages going into default, which then turns into possibly foreclosure, we are at some of the lowest default risk we've had going all the way back to 1999. And the reason is our lending standards, the guidelines at which the mortgage underwriters are underwriting to has changed drastically. And it's a two-part process. You have product risk and you have borrower risk. And if you'll recall, back in 04, 05, 06, we had both very high risk when it came to the product, and we also had very high risk when it came to the borrowers. And what do I mean by that? So an example of product risk would be interest-only loans or a negative amortization loan where you really weren't paying down the principal at all, but you were just paying the bank. You were essentially just paying your interest. And in some cases, that was a negative amortization where the amount that you owed actually increased every month. Banks still got paid, but you as the consumer were not gaining any equity. So that would be an example of product risk. So back in 04 and 05, we did have interest only. We had negative amortization loans, which are no longer in place. An example of borrower risk would be lower credit. Back in the day, you could have purchased a property with a lower or minimum credit scores that were diminished compared to where they are today. So borrowers did not have to show and did not have to have quite the credit that they have today. Another piece with that was, if you all recall, the stated income, no documentation loans, which were extremely popular during the peak of the market in 04, 05, and 06, where essentially you did not have to give any documentation. Yes, they pulled credit, but the credit scores standards were lower, but you did not need your W-2s, you didn't need your tax returns. There was many more self-employed borrowers who were taking advantage of that. Thus, that was a very high borrower risk. Fast forward to 2020, and the standards of both product risk and borrower risk are extremely more restrictive today than they've ever been. You need to be able to show all of your income. They're going to verify your assets. And in fact, a lot of our buyers say that it's actually a pretty invasive process. And that's true. The reason that is in place is because of what had happened in the past. So our credit standards, our lending standards have gotten much more stringent. Thus, we are in a position right now where the default risk is the lowest it has been since 1999. Another piece to show why we are not in a housing bubble or in a crisis situation is there's never been a time where homeowners have actually had more equity in their home. This is coming from the Deputy Chief Economist for First American, and the national loan to value in Q4 of 2021 was 30.8%. That's the lowest LTV, loan to value, in over 3 decades in inflation adjusted terms. In fact, homeowners in Q4 of 2021 had an average of $307,000 in equity in their homes. That's the average throughout the entire country. $307,000 worth of equity, which is an historic high. And the simple fact is that homeowners are not going to walk away from $307,000 in average equity in their homes. compared to 2004, 2005, 2006, when things were running up, and then we had the crash of 2008. Many of those home buyers or owners at that point were underwater because of some of these low down payment, negative amortization, risky loans. So it was a no-brainer at that point. If they didn't have the ability to repay it, it was very easy to walk away from that because there was no equity. Today, there's lots of equity. People aren't going to walk away from it. And in fact, there's still so much supply shortage and high demand that those people who are in risk of default could simply put their homes on the market and sell them and make a profit. So it's a much different situation today as opposed to where we were back in 2008, 9, and 10. Where are home prices going? That's a question that I continue to get. And with the supply and demand, yes, I just mentioned here that as interest rates rise, typically prices rise as well. And when we look at across the board out of the average of all 7 of the forecasts, including Fannie Mae, Freddie Mac, CoreLogic, NAR, Ivy Zelman, the Mortgage Bankers Association, the average estimated increase in home price appreciation forecasted for 2022 is 9%. So we see a high of 10.8. The Mortgage Bankers Association's on the complete opposite end. So Fannie Mae, the housing authority, says 10.8 is what they're expecting home prices to increase here this year, where the Mortgage Bankers Association is saying 6%. We average it all together, and it's 9%. So that's still very strong home price appreciation expected here in 2022. A lot of that has to do with our supply and demand situation. Where do we go from here? We know 2022 is going to have low inventory, high demand, prices will continue to go, but what are we expecting over the course of the next 5 years? And that's where we see that here in 2022, prices are going to continue to rise at a fairly high clip, on average 9%, but the forecasters are expecting that in 2023 we'll see 4.74, in 2024 3.67, 2025 3.41, and then increasing back up again in 2026 to 3.57%. So what does that come out to? And if you were to buy a $360,000 property in January of this year, if you bought a $360,000 property in January of 2022, the experts are predicting that the value of that home in 2027 would be $456,000. So that's an equity increase of just under $100,000. So $96,000 in potential equity earned if you are to buy here in 2022. That's still a very strong outlook as we continue to move forward. Now, obviously, I did not compile all of these numbers. They've come from third-party sources. I just try to gather that information, give you the facts, and let you decide as to what you think is going to happen in the marketplace. And I would love your feedback. I'd love to have your feedback in the comments below. And if you think this is something that you would like to continue to get as we move forward, please like, subscribe, and sign up to get additional information, as I'd be happy to share it with you moving forward. So the last piece that I do want to touch on, and that's a lot of these numbers have been national numbers, but what does it look like for us here locally? And I thought I would just share, where we're at today. And the simple fact is that we are still in a very strong seller's market. And if we look at our numbers, right now in Worcester County, Maryland, we have 225 properties for sale as of today. In the last 30 days, we've sold 235 properties. So we are still less than 1 month's supply county-wide. If I break that down specifically to Ocean City, we have 132 active homes and or condominiums in the 10 miles of beach. And over the last 30 days, we've sold 150 properties. Once again, less than 1 month's supply. Finally, Ocean Pines, which I always find the numbers in Ocean Pines to be very fascinating. Keep in mind we have 14,000 year-round residents in Ocean Pines. That number here in the next couple of weeks will swell to about 21, 22,000 summertime residents. And currently we have 23 homes for sale in that entire community. Maryland's largest homeowners association, Ocean Pines, has 23 homes for sale. And over the course of the last 30 days, we've sold 41 homes. So just about half a month's supply in Ocean Pines right now. And while there are external factors as we just went over, the supply and demand feature is very real. And as when we still can see this imbalance of low supply, high demand, that is going to make prices continue to rise for the near term. So once again, that is your market update here for May. If you like this information, you want to have more, please like and subscribe. Feel free to give me your comments below. I'd love to get your take on the marketplace and or get your take on what's happening in your local market. Thanks again. Have a great day.